Hello everyone, my name is Elaine. I'm coming from UBP Asset Management Asia. Today is July 22nd. I'm happy to be here to meet with our Taiwanese investor. So today I'm honored to have two portfolio managers also coming from UBP Asset Management to meet with our Taiwanese investor. Thomas Christensen is the CIO of Emerging Market Debt and Jack Dino is the head of Emerging Market Corporate Debt. So thank you, Thomas. Thank you, Jack. That's a great speech. So we actually have some questions from our local investor in Taiwan, and I want to take this opportunity to hear some thoughts from you. So I guess the first question will be for Thomas. You have mentioned something about sovereign credit analysis. Can you tell me which area will be your main focus for the sovereign bonds? Asia, Latin America, or Eastern Europe? And is this the interest rate or credit rating that you are considering when you do the analysis and selection?
Thank you, Lane. So start with the second part first. I would say, frankly, it's neither. The main thing that's driving is our own view. We have a view that rating agencies tend to, frankly, lag the market move. So we do our own very deep analysis of each of the countries we invest in. And base most of our investments on that rather than what the agencies are doing. Now, we do believe that if there are countries that are being downgraded or upgraded through the investment grade level, either falling angels or rising stars, that can have an impact. And so we do, of course, consider the rating agencies, but the most important is our own view. Now, given it's primarily investment grade and most of these credits are not at risk of default, we're really trying to maximize the carry to vol. And where we can find some level of spread compression. And so currently we see the most opportunities in Latin America and to a lesser extent Eastern Europe, whereas the majority of the countries in Asia are trading at extremely tight levels and just not giving you enough carry.
I see, thank you. So from year to date, we have seen emerging market attracting substantial inflows, and particularly from investors that is outside US. Can you tell us what is the key drivers behind this renewed appeal, and is the factors related to the weaker US dollar or improved macro fundamentals?
Yeah, so I think both of those two play some role. If I start at the very, very big picture, I would say we've seen years of underallocation to emerging market debt and equities as well, frankly, but from global investors. So if you look at emerging markets, they make up more than half of the world's GDP growth today, and a substantially larger portion of that in terms of the population and consumption as well. And so the fact that emerging market debt make up less than 10% of global investors' allocations, I think is a real signal that there's not enough investment into emerging markets historically. And I think there's so I think, and for years we've seen that. So I think there's a bit of a give back on that front. But I do think the challenge to the idea of U.S. exceptionalism, which is driven certainly by a lot of the policies you're seeing out of the U.S., is having a real impact. One of the things that Donald Trump has made it very clear is he wants to tackle the U.S. current account deficit. And on top of that, he believes the dollar is too strong. And frankly, if you look at most valuation metrics, the dollar is likely overvalued. And both of those two factors are very helpful. If the current account deficit in the US decreases, the amount of capital you need to fund that current account deficit, of course, goes down, so the capital can flow elsewhere. And lastly, yes, of course, the weaker dollar is a boon for most emerging market countries, particularly on the local currency side, which is where you have seen most of the inflows, but also to some extent hard currency. So I think it's a multifaceted discussion. But there are quite a few factors, frankly, that point this direction.
I see. Thank you. Since Thomas, you mentioned about Trump, I do want to explore this with Jack. Since January, we have seen recent or anticipated tariff measures become Trump's major weapon. So I want to know from you, do you think it impacts the outlook of emerging market? Are there any specific sectors or regions within the emerging market that are more vulnerable or resilient to such development?
Well, first of all, I think you need to understand that the tariffs are just as impactful on the U.S. as it is on the target. I mean, there's also counter tariffs, there's cross-border trade, there's a plethora of issues that make that so. So at the end of the day, it started out with very, very high tariff levels, and the idea was to start from a high base and to cut a deal. And now that we're getting closer and closer to the deal part of it, I think we're much further, we have much greater visibility, if you will, now than we had, let's say, at the beginning of the year or even in April after Liberation Day. And I think as far as most emerging markets are concerned, the impact on GDP will be at most 1%, if not far less. So if we take a look at that and we bring that down to the company level, our team has done substantial stress testing on all the names in our portfolios. And what we can say is we don't have any cases where there would be an impact on EBITDA of more than, let's say, 10%. And in no cases of specific credits that are within our portfolios would we have a meaningful deterioration in credit metrics. So what I could say overall is, you know, it's a moving target and there's a lot of things still going on, but the sectors and industries logically that would be impacted would be metals and mining, basically through tradable steel and aluminum, and sectors of the manufacturing industry, specifically that depend on cross-border global supply chains. And, you know, look, at the end of the day, most corporate debt are domestically focused, whether it be telecom, whether it be retail, whether it be financials. And what we think is that at the end of the day, if GDP and growth isn't impacted significantly, we think those sectors should continue to thrive, and we see overall very little impact.
I see. Thank you, Jack. So as you mentioned above, emerging market responsible income portfolio is a registered product in Taiwan. I would like to know to what extent do tariffs or trade tensions factor into your portfolio positioning for this fund, and do you actively adjust exposure based on potential policy shift or geopolitical risks?
Well, we take it into account, and it can go both ways. I mean, one side of the table, as I mentioned, we've stress tested every single credit or company or financial in our portfolio to understand the potential impact. But then also we look at valuation, and in a lot of specific cases, we've seen companies where they've been in quote unquote target sectors, specifically in the manufacturing industry, specifically in a country, for example, like Mexico. And what we've seen is sell-offs that were unwarranted, so we've taken advantage on a tactical basis to buy or to add some of those credits that we think are long-term rock solid, but that are getting sold off for what we might perceive to be all the wrong reasons.
Got it. Anything you would like to add?
No, I mean, I think it's important to stress what Jack just said, which is the same thing as we talked about on ESG, is this is a threat and an opportunity. So yes, it factors in, and we have seen more recently more diversification and I guess differentiation across different countries who's being treated which way. But it also, as Jack mentioned, leads to opportunities. So where it's not factored in the spread, so for example, I already mentioned, but we don't have any exposure to Asian sovereign debt at the moment. Most of those countries are manufacturing type countries and trade at extremely tight spreads, and so we don't think the spread potentially accurately reflects the risk. But on the other side of that, you have, particularly in the corporate side, a whole number of companies that widen significantly on a perceived risk that we think is frankly probably overpriced.
Got it. So Thomas, you had mentioned that you have some exposure to the countries that you like. Let's say Mexico, Peru, and Chile represent some of the top country allocations in the current portfolio. And could you just tell us more on the specific opportunities or strengths that support your investment rationale?
Yeah, I mean, this is actually, I'm going to turn it almost straight back to Jack, because actually all these three countries we have, I would say, some allocation on the sovereign side, but relatively limited. I would say within Latin America, Uruguay is actually probably our largest position on the sovereign side, which we perceive to be the strongest credit in Latin America, if not all of investment grade sovereign space, to be honest. But again, the great thing about this fund is we can play in corporate and sovereign land. And so Mexico on the sovereign side, we're actually getting a bit worried, in part because of the the contingent liability of Pemex. So we have a pretty small position in the sovereign side, and Chile and Peru to some extent as well, and we have very significant positions in some of these corporate names, which I think Jack can talk about.
Yeah, I mean, so we look at the names very, very much on a bottoms-up basis, and we know in Mexico there's all three of these countries. There's a lot of negative headlines, whether it be Mexico for the trade talks, whether it be Peru and Chile for upcoming elections and potential, political issues, which we don't view as completely unfavorable. But at the end of the day, a lot of these companies have, significant operations outside in other even developed countries, and or these are companies that will do extremely well no matter who sits in the presidential chair, or no matter what the political outcome has been, and history has warranted that. So we feel very, very comfortable being involved in all three countries, and like I say, it's a best idea focused, and we're just consequentially finding a lot of really solid ideas in these three countries.
I see. Well, that's great. Thank you, Thomas. Thank you, Jack.